Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the future of the Fed, what President Trump's nomination of Stephen Miran means for the FOMC, interest rates, and the next leader of the Fed. Plus, Under Armour's turnaround effort hitting a snag after a weak earnings report. We'll discuss the outlook for the sportswear retailer with an analyst this hour. And plenty of headlines in the world of entertainment this week. We've got the investor playbook on the winners and losers in the streaming space. Let's get a check of the markets here. We are seeing some strength across the board here to end the week. We've got the Dow gaining almost 200 points, bouncing back from losses yesterday, up about 0.5%. The S&P 500 extending gains up 0.6%, and the NASDAQ looking like another record close. If we keep going like this, it's up almost 0.2%. Taking a look at the bond market as well, we are seeing a little bit of a yield increase today. That's despite the fact that really we see broad expectations for a September rate cut being priced into markets. Still, the 10-year yield at a pretty low level at about 4.28%. Well, of course, feeding into the bond market, President Trump has nominated Stephen Miran, current chairman of the Council of Economic Advisors, to replace outgoing Fed Governor Adriana Kugler. The nomination coming amid persistent pressure on the FOMC from the White House to cut rates. After holding rates steady in July, dramatic downward revisions to the labor market data prompted a dovish about-face among some Fed leaders like Neil Kashkari and Mary Daly. We're taking a look at the state of the U.S. economy through both data and anecdotes, what that all means for the Fed. Joining me now, Fed correspondent Jennifer Schonberger and our executive editor and host of Opening Bid, Brian Sozzi. Jennifer, let's start with you here, because we're not just sort of reacting to Miran, but it's about the implications of his appointment and what we can then expect from the Fed in terms of interest rate policy.
Yeah, look, assuming he gets confirmed, Julie, this is another dove that would be sitting on the Federal Open Market Committee. We know he views President Trump's policies, which he has been one of the architects himself, as disinflationary. He's basically a super dove. He sees no reason why the Fed shouldn't be cutting rates now. And as you mentioned, we did see that weaker than expected jobs report for July. Feels like a little bit of deja vu, right? From last year when we saw the same thing play out in the Fed cut in September, except this time you've also had major downward revisions to the prior months. And that seems to be the case that could happen going forward. That seems the trend that we're seeing. So if we get another jobs report right before the FOMC meeting that is weak again, then we could see perhaps the committee flip towards cutting rates in September. Now, I think it's not a slam dunk. There are members of the Fed like Raphael Bostic, who is still looking at one cut this year. He's not totally convinced that that weak labor market report is enough, given what he's hearing in terms of inflation stemming from tariffs down the pike. The same could be said for the vice chair of the FOMC, John Williams. So again, if Miran is appointed to the Fed and confirmed by the Senate, he would be another dovish voice on the committee.
Right, exactly. And, I have talked to some investors who say they do think it's a slam dunk. Some people even floated a half-point cut in September to sort of catch up. So we'll see, as you say,
I'm just listening to members of the Fed, Julie, who are saying certain things. I know the markets want what the markets want.
Yeah.
But there are clearly members of the Fed who don't see it as a slam dunk at this point.
Right, most definitely. You have to listen to the actual people making the actual decision. And speaking of the actual people making the actual decisions, Brian Sozzi, you talked to Stephen Miran, and so you sort of got a feel for his thoughts on tariffs and policy, et cetera. What kind of were your takeaways from that?
Well, Julie, maybe I'm still fired up from doing Opening Bid. I just ran over here to be on set with you. But look, I think the market should be happy that this is not a former Fox News host coming here inside to work inside the Federal Reserve. This is a very competent economist. I think Stephen knows what he's doing. I've talked to Stephen numerous times in the past. In fact, we just talked to him more than a month ago. Here's what he told me on tariffs.
The president is using tariffs to negotiate reductions in non-tariff barriers so that American goods can enter foreign markets and that we have reciprocal and fair trade. If American goods are entering foreign markets, then we're selling more. And so revenue still goes up either way. You just substitute tariff revenue into normal tax revenue.
Anyone, Julie, that was going to get this potential appointment or get this move or picked by the president was going to get labeled as a Trump appointee. They want to cut interest rates, and that may very well be the case with Miran. But at the end of the day, he has the experience. I think he understands the U.S. economy, how it's all interconnected, and for that, I say it's good.
I guess it could be worse. Is another
fair to say too, Julie?
Another way. Yes, he is not a Fox News host, to your point, or a reality TV show veteran, for example. So, Jennifer, the next big report that we've got coming is CPI next week, which could further inform Fed policy. What is the sort of thinking around that? Because we have the labor deterioration that makes perhaps CPI even more pivotal here.
Yeah, I think that the CPI report next week is going to be informative, but I think what's going to be more informative is the next labor market report from the BLS. Because if that shows continued weakening job growth, if that turns negative, that's probably going to trump the inflation reports. If, however, we get a spring back in job creation following the weaker report that we saw for July, then the Fed is going to look more towards inflation again. And they're going to say, look, if we do see a step up, as is expected for CPI, back up towards 3%, which would put them a full percentage point above their 2% target, so moving in the wrong direction there, then the Fed may be inclined to still hold steady. And again, we have seen members like Cleveland Fed President Beth Hammack, who has said, look, yes, this report was a bit alarming, especially with the revisions downward, but looking at other indicators, looking at quit rates, looking at initial unemployment claims, the job market still looks like it's in a solid position. So I think there are still a number of members on the FOMC who need to be convinced, who are still more concerned about the inflation side of the dual mandate. And they're particularly attuned to this because we have just come off a period of high inflation, and they keep hearing from people in their districts that they are concerned about inflation.
Let's talk more about the labor part of the equation. Hope King joining us now, Macro Talk News founder and Yahoo Finance contributor. Hi, Hope. So
hey.
I know you've also been talking to a lot of folks about the labor side here. What have you been hearing, and what's that sort of more anecdotal or anecdata, as we like to say, perspective?
So a lot of economists are paying more attention to that anecdata because for a long time now, over the past 12 months, that sentiment amongst workers in the anecdata, it hasn't matched up with what the strong numbers have been showing. And now with the muddy waters, I think a lot of economists are talking more about what one, for example, Heather Long at the Navy Credit Union told me yesterday is a deteriorating labor market. So she had previously called it frozen. Now she's saying that the cracks are showing and that the labor market is deteriorating. And if you look at by sector, you can see what she's talking about. If you actually look into the sectors that are actually adding jobs, it's really only two: leisure and then healthcare and social services. And every other big sort of sector that we've seen, construction, mining, in the last 3 months, they've actually been shedding jobs. So the kind of catch up that we're seeing in the data with the revisions is now, I think, finally reflecting some of the anecdote that we've seen and heard from workers, which is that if you have a job, you're anxious about losing it. If you haven't found a job, I mean, there's now since the pandemic, the highest number of repeat claims for unemployment, and that's also been very worrying. And then if you are again a worker today, because you're seeing your colleagues get laid off, that's not only adding to your anxiety, but also to your workload. They're getting burnt out. And so this is now really all coming into the mix.
And Saz, you and I have been talking to a lot of executives this earnings season. So I'm curious to ask you sort of a vibes question, both about inflation, the economy, labor. What do you think?
Well, I just got off on opening bid, Julie, with Chime CFO.
Right.
And of course, they sit at that intersection of households earning under $100,000 a year, so price-sensitive consumers. Told me Matt Newcomb, the CFO of Chime, saying that consumer is steady. That's good. But I also followed up and asked him about what he's seeing in terms of prices for the services they're paying for, like gas and everything else. He said prices are starting to rise. I happen to be of the view, Julie, that inflation is coming. Maybe not big double-digit gains because of tariffs, but the inflation is there, and it's going to, I think, stick around in a lot of these macro reports like Jen was laying out as well. But at the end of the day, day, I think it's still the AI trade, Julie, that's driving this market. And I got to ask Stephen next time when I get to talk to him, his thoughts on NVIDIA. Maybe I can talk to him before NVIDIA reports on August 27th. That's the big market driver, Julie.
That's a great idea. I mean, that is definitely the market driver here. I think the question is below the surface. You have an Under Armour today, right? You have a Wendy's that's suffering. We're going to have on an executive from Elf Beauty this afternoon, which has raised all of its prices across the board because of tariffs. So there are definitely these individual examples. And look at the jobs report, which tells the story, I think, as well of what's been going on.
You need jobs to purchase those fried chicken sandwiches at Wendy's, Julie.
Yes,
bottom line.
It helps.
Yep.
Jennifer, Brian, Hope, thank you so much. Appreciate it.
Thanks.
Got much more markets action coming up, including a look at the currency markets and how they're reacting to all of these cross currents. You're watching Market Catalysts. The dollar edging lower, headed for a weekly loss as President Trump tapped senior economic advisor Stephen Miran as a fill-in Fed governor after Adriana Kugler announced she was stepping down last week. This choice, along with weakening economic data, boosting expectations for rate cuts. Here with her expectations for rates and their impact on currencies is Jane Foley, head of FX strategy at Rabobank. Thanks for being here, Jane. We appreciate it. So how does the Miran pick sort of add into the expectations that have already been changing out there for a rate cut potentially coming in September? And then what effect does that have on the currency market?
Well, thank you for having me. Now, of course, everybody knows that Miran is a dove. He doesn't see the inflationary impacts of Trump's policies. And therefore, if he has been approved by the Senate from September, then it does increase the likelihood that the Fed will already be going for an interest rate cut. But, of course, many people had been anticipating already that the Fed is likely to go for a cut in September. So from that point of view, perhaps it doesn't influence the market expectations all that much. Now, what could change those expectations is, of course, the US CPI inflation data next week. That is expected to come in a little bit higher, perhaps, than the Fed will feel comfortable about, and certainly add back to the arguments that Powell has been making, that the Fed has been waiting to see the impact of these tariffs on inflation. But that aside, with the labor market loosening, I think the market is firmly expecting that the Fed will move in September.
Jane, is that your base case as well?
You know, what's quite interesting about the base case here at Rabo is that, yes, it's September has been, our base case for some time. But what we have recently changed our view to in 2026 is that we probably see as many as 4 interest rate cuts. And the reason for that is actually quite political. It is, well, we were assuming that Kugler's place would be replaced in January by someone perhaps more dovish. And that if the Fed Chair Powell, does step aside from his role as governor when his chairship ends in the spring, that too would make the FOMC far more dovish. So we were anticipating that some of these interest rate cuts would come because of the dovish bent or slant that we are likely to see from the FOMC. So we are anticipating that we will get more interest rate cuts next year because of that sort of political slant, if you like. But it is still going to be interesting how the labor market data and how the inflation data do pan out.
Yes, most definitely. And what, in your view, is priced into the dollar trade at this point? Obviously, we've seen some weakness here. Again, is the assumption there that we're going to get multiple cuts this year? And where is there room for maybe disruption of that view in the market?
Well, the market is certainly thinking that, through into 2026, we will get further Fed easing. And, a lot of that has already been priced in. I think what is perhaps more interesting for forecasters, but equally very difficult to forecast, is whether or not there will be sort of more implications of perhaps partisanship within the US systems. We did, of course, see the head of the Bureau of Labor Statistics lose her job last week. And of course, with the Fed roles coming up for reappointment, that raises or already has raised the issue of Fed independence. So whether or not that will feed into credibility, whether or not that will have an impact on the dollar as investor confidence gets affected, we'll have to wait and see. Now, that is not our base case. But certainly it is worth, watching and debating whether or not that does come through into more of a market factor in 2026.
Is there any real risk to the dollar status as a global reserve currency?
Well, it's going to be impossible to replace the dollar as reserve currency. The US capital markets are just so deep that they cannot be replicated. But, we heard from Lagarde, head of the ECB in May, that, she would probably want to chip away a little bit more at that. And I think from the Chinese authorities, well, they've been chipping away for the last few years. And what I mean by that is that, both of them will probably try and make more of their trade invoiced in their domestic currencies, not the dollar. And, when we look at a trade that is invoiced in a certain currency, there is a rough correlation between those currencies, the invoicing currencies, and central bank reserves. So the dollar is certainly at risk of having its status eroded, as it has been for the last 20 years. But of course, the US Treasury will push back against that significantly. And it's quite possible that they want to see stablecoins as a means of trying to push back. So again, very interesting next few years, I think, on that front.
How would that play out in your view if they sort of use stablecoins as that kind of a tool?
Well, the US dollar, the US Treasury have a massive advantage going into the fact that the dollar is already used so widely around the world, since really the Second World War. It's internationalism. It can't be replicated by any other currency. It's widely used as a transactional currency across emerging markets across the world. It's still around about 50% of invoices are denominated in US dollars. Again, there will be push against that from China, from Europe particularly, but the dollar is very dominant. And because so many people around the world already use US dollars, then perhaps it is going to be easier for them to use stable coins with that backed in the US dollars to just transition on that front. So there is an advantage that the US Treasury have in sort of rolling this out. But of course, we do need to be wary of some of the warnings that we've had, the warnings from the BIS, for instance, indicating that if this is done incorrectly, it could undermine consumer confidence in money. So, that there are clear risks to this.
And Jane, lastly, I would ask for the remainder of the year, if we're going to continue to see dollar trade lower or sideways, do you have a particular currency or group of currencies that you really think is going to be an outperformer for the rest of the year?
I think the yen certainly could be, and that is on the assumption that they are able to hike interest rates perhaps before the turn of the year. That speculation is out there. There is some optimism that the Japanese economy will allow an interest rate hike by potentially October, perhaps a little bit later on in the year. We had good news again yesterday on the trade front. Some of the murkiness of that trade deal between the US and Japan being cleared up in Japan's favor. So that will certainly help, as will the pay deals that have been coming through. But of course, real wages are still being embattled really by the high level of inflation. But arguably that should make the Bank of Japan keener perhaps to suppress inflation and go ahead hiking interest rates. So again, I think the yen can certainly make a little bit of headway, and the euro too. Bearing in mind that the market's anticipating that the Fed is going to be cutting through next year. The ECB could be done. We could still see a slow move higher, but again, it's not going to be to the advantage of European exporters to see the euro strengthen, and that's not necessarily what they need or want.
Right, especially at a time when they are paying tariffs if they're exporting to the U.S. Jane, thank you so much. We appreciate your time.
Thank you.
Coming up, some of this morning's trending tickers, plus a guide to the winners and losers in entertainment stocks. That's next. Now time for some of today's trending tickers. We are watching Boeing, Trade Desk, and Crocs. First up, we got Boeing. The aerospace giant's $4.7 billion acquisition of Spirit AeroSystems has been cleared in the UK. The deal is expected to close in the fourth quarter. Now, Boeing executives said the deal would improve the safety and quality of its manufacturing. Meanwhile, today marks 1 year since Kelly Ortberg took over the Boeing CEO post. The stock is up about 35% during that period. Next up, shares of Trade Desk taking a beating after CEO Jeff Green warned that tariff uncertainty began to weigh on some leading global advertisers. The company also announcing the sudden departure of its chief financial officer, a board member who spent nearly a decade at Salesforce in executive roles will take over that position on August 21st. The stock is on pace to wipe out more than $12 billion from the company's market capitalization. And finally, shares of Crocs rising after getting pummeled yesterday. The shoemaker met Wall Street's second quarter revenue expectations, but guided for lower sales in its third quarter, saying it expects tariffs to weigh on results. Crocs had already withdrawn its financial projections for the full year, citing global trade uncertainty and its impact on a softening economic landscape. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Lots of news in the entertainment world this week, from Fubo TV moving closer to its combination with Disney Plus and Hulu, to Paramount finalizing its merger with Skydance. Yahoo Finance talked to an analyst to help break down the winners and losers in the streaming space.
We're seeing some big names in the streaming space reporting earnings, including Disney on Wednesday and Warner Brothers Discovery on Thursday. Both those stocks have been under pressure as the battle continues for streaming rights, particularly for the NFL. We're navigating how to play the streaming sector with the Yahoo Finance playbook. Joining me now is Jessica Reif-Ehrlich, Senior Media and Entertainment Analyst at BofA Securities. Jessica, now that we've heard from a fair amount of the streamers, I guess from a high level, zooming out, what has been one of your bigger takeaways, or maybe the biggest takeaway of what we're learning about the various companies in the space and sort of who's leading and where everyone's at in this process?
I mean, from the traditional media companies' perspective, they are all turning the corner. They're starting to see profitability. They're inflecting to profits. Disney reported great numbers and raised guidance. The same with Warner Brothers Discovery. So their businesses have turned the corner. Subs and revenue are growing. They're still rolling out, in Warner Brothers Discovery's case, in more countries, HBO Max, with more to come in the first half of 26. But unlike Netflix, which of course has been doing a phenomenal job, traditional media companies are battling the headwinds from the decline of, or the secular headwinds from pay TV. So from a streaming perspective, it's actually been very strong. But from the rest of their business, there are still some significant challenges.
In the big headline, it felt like over the last week was the Disney NFL deal, right? And as a Red Zone watcher, the fact that Red Zone will now be on ESPN, how much does that mean for Disney's actual business to be able to have Red Zone and have that sort of product?
Disney had a ton of news in the last day or so. As you mentioned, like Red Zone with NFL. So the NFL deal doesn't technically close until the end of next year, so it doesn't affect Disney's numbers until fiscal 27. Having said that, their relationship with NFL has been cemented. They will get an incremental 3 games. They'll move games around to different platforms. And so it just strengthens their hold on sports significantly. We would not be surprised to see other sports networks, platforms bundle with ESPN. ESPN is clearly the leader in that. But there was other news in Disney's streaming besides the NFL, which of course is a really big deal. On the call yesterday, Bob Iger talked about rolling Hulu into the Disney Plus app on a global basis. So they'll rebrand from the store name, which was their Indian operation, to Hulu, and it has puts and takes. So when you see these kinds of combinations, there has to be pressure on revenue. We'll see what the bundle price ultimately is. They have not announced that, but there will be a definitive benefit from a cost perspective, from marketing and technology, should help engagement, should reduce churn. So, we're trying to parse through these numbers is a little bit difficult. There were a lot of moving pieces in Disney's announcement yesterday related to streaming, including the NFL.
And Disney, of course, has a broad other business, and several of these other companies have linear cable networks that are also part of the business. The one that doesn't, as you mentioned, is Netflix, right? And that's sort of your pure play still for streaming. Is that, if you're looking to invest in the streaming space, is that still the most attractive option because of the fact that it's a pure play, streaming play, or is it maybe not, given the stock has been, seems like running wild for a while now? Not off earnings, but leading in earnings at least.
Yeah, but it's night and day valuation. So yes, it has a clearer path because it's not burdened by these legacy businesses. We'll see. There's going to be M&A in media in the coming year. Does Netflix play a part in that? If they choose to, then they may be burdened by some of these challenges as well. But they would only do it if they thought there would be a big benefit in terms of owning more IP. But on the other businesses, so yes, like Warner Brothers Discovery had a fantastic quarter led by streaming and studios. But the linear business, while it was actually fine this second quarter, there are some challenges in comparisons in the second half. So that will weigh. That is what is weighing on the shares today. Disney, on the other hand, had like phenomenal outlook on experiences, which is basically their theme parks and cruise ships. So the theme parks, despite increased competition from NBC Universal's Epic opening in May, did extremely well in Orlando. Bookings are really strong, and they have 2 new cruise ships coming on this calendar year, in November and December. So the outlook for Disney on the experience side is incredibly positive. So they're just puts and takes. So if you want a simple story, it would be Netflix, but you're paying for it at a significantly higher multiple, like 4-fold what the other companies are trading at.
Under Armour shares plunging this morning after the company forecast a worse than expected drop in sales for the current quarter. That would make its 10th straight quarter of sales declines as Under Armour attempts to execute a turnaround plan amid steep tariffs imposed by the U.S., which it expects also to affect margins. Here to break down what's next for Under Armour, David Swartz, Morningstar Senior Equity Analyst. David, it's good to see you. So Under Armour really suffering here. I know it is attempting this turnaround, but how do we sort of assess its progress when we keep getting quarters like this?
Yeah, it's very difficult. Kevin Plank, the CEO and controlling shareholder, is always very optimistic on the calls and is very confident that the business is turning. But the reality is that the numbers are very poor, and they have been for quite a while. Part of the problem is that there are very long lead times in the apparel and footwear space. And so changes that are made today don't really reach the consumer for about a year and a half. So it definitely is a long-term process. And right now, we sort of have to just hope that things are getting better, because we don't see it in the numbers that Under Armour's been reporting.
Well, and, you know, he came back a while ago. He's working, he's been working on this turnaround for a while. So even if there's long lead time, like, shouldn't changes he instituted a while ago now be bearing fruit in theory?
Well, you would certainly hope so. However, the sportswear market itself really is not in great shape. If you look at some of the other companies out there, like Puma, for example, reported very poor numbers and a very poor outlook when it reported its second quarter. Nike has been struggling greatly over the past year and a half. So Under Armour is trying to pull off this turnaround in an environment that really isn't that favorable for the sportswear market in general. And so that's making it more difficult. But realistically, there's a reason why the stock is at $5. The company has had, a turnaround in place for about 9 years. This company has had one strategic plan after another, and we just haven't seen the benefit of any of them. And so people really have lost confidence that anything is going to get better. I do think that it will, but we certainly are not seeing it in the current fiscal year, and the turnaround is taking much longer than people hoped.
What would make it get better? If there was any kind of silver lining or something to look forward to for folks who have held on with this stock, how would that play out? What would it look like?
Under Armour still has the advantage that the sportswear market is still very favorable. Right now, it is not doing very well, but it is an area that does have growth, and there aren't a lot of growth stories in the apparel and footwear space. Under Armour does have a strong position in the U.S., which generates most of its sales, and it still is seen as a solid performance sports brand and has that market placement, and that does give you some confidence that it can bounce back. It is definitely one of the weaker companies in the space right now, but it has established itself, and the valuation is very low right now, and also the balance sheet is strong. Under Armour isn't in any danger of any financial distress or anything like that, and so the market cap just really reflects a lack of confidence that it can turn it around. I do think that the stock is very undervalued. My fair value estimate has been around $14 a share. So I think that expectations are so low that there is a possibility for a long-term investor here.
Gotcha. I want to talk about tariffs also, of course, David, because that's important with this story and indeed important for all of the companies that you cover, because that has been such a weight on many of them. What does the manufacturing mix look like for an Under Armour? And so how sustained, how bad do we think that the tariff effect could be?
Like just about everybody else in the sportswear space, Under Armour is heavily exposed to Southeast Asian production. Vietnam has emerged as the #1 sourcing country for athletic footwear in recent years. And so the tariffs that were placed on countries like Vietnam and Indonesia and Cambodia have affected this industry really across the board, and it's affecting Under Armour. The company came out and said that the tariffs are going to cost about $100 million in extra cost of goods sold, which is an expense that Under Armour right now really does not need because its business is struggling. And so the tariffs are an added complication and really something that's affecting the whole industry.
David, are there companies in your coverage that either because they're not as exposed to those areas or their sales volumes are such that it kind of outweighs some of it, or they have pricing power, that that are sort of more resistant within this tariff environment?
Yes, definitely. Across this space, there are some companies that have much greater pricing power than others, and those companies can raise prices and consumers will accept them. Under Armour isn't in that category, but some that would include perhaps Nike and Adidas, as well as maybe Deckers, which owns Hoka. Companies that have stronger market position have generally higher prices anyway, and also another benefit is that some companies are much more international than others. So if you look at Nike and Adidas, for example, of course, the U.S. market is very important for them, but they're global businesses. Whereas if you look at Under Armour, it's really exposed to the U.S., and so it doesn't have that international diversification that right now would be very, very, very beneficial, given that the problem is focused solely on the U.S. The bigger problem in the long term is that nobody knows what's going to happen with sportswear demand because of the tariffs. If inflation goes up generally and inflation on footwear and apparel goes up specifically, that could definitely depress demand, which would affect everybody in the industry negatively, no matter how much pricing power they have.
And of course, we're still kind of early in earnings season for a lot of more retail names, right? We don't get Nike, for example, until the end of September because they're on a bit of a different schedule. What are going to be the main questions that investors should be asking or looking for the upcoming reports?
I think at this point, people are wondering, how much direct impact will it be from the tariffs and how much can it be mitigated? Some companies have said that they can mitigate most of the cost. Others have said that maybe very little of the cost. It really depends on where they are in their pricing situation and demand and their supply chain. There's a lot of different variables, but that's certainly going to be one of the questions that's being asked. And then also, what is the effect of tariffs and the economy on demand generally? Like as I mentioned earlier, it has been kind of a difficult period for sportswear. There have been some companies that have been doing better. Certainly Adidas has been one of them, and Deckers as well. But Nike and Puma and others have been struggling. So the market itself is not 100% healthy right now, but there certainly are winners out there too.
David, thanks so much. Appreciate your perspective.
Thanks.
We got much more markets action coming up. We're also going to take a check in on the casual restaurant sector next. Wendy's is falling today after the burger chain cut its full-year outlook. U.S. same-store sales have been slumping. And this after Texas Roadhouse missed second quarter earnings estimates but saw same-store sales climb more than 9% year over year. Joining me now, Gregory Frankfurt, Guggenheim Securities Senior Analyst. A little bit confusing here, Greg, because we see Wendy's rising, and we see Texas Roadhouse falling. I guess let's talk Wendy's first here. The numbers look pretty lousy. So any reason that we would be seeing the shares up?
Yeah, I think, look, data has proliferated in this space. So the financial community gets a read on some of these sales as the quarter progresses. And there was some expectation that Wendy's same-store sales and profitability might be pressured. They reported a same-store sales in the U.S. down 3.6. You are seeing weakness in the lower and middle-income consumer that is really hurting quick service companies and their results. And they cut their EBITDA guide for the year by about 5%. But I think given the fact that shares have been under pressure for the last few months, this was starting to get figured out by investors, and I just think that's what's driving the reaction today.
Yeah, I also noted it's a pretty heavily shorted name. I think about 13% of the float is sold short, so maybe that is a factor as well here. But sort of fundamentally, what is going on at Wendy's when it says its sales are going to fall between 3 and 5% this year? What's sort of the issue there?
Yeah, I think the issue that's happening, and you've heard this from earnings reports earlier this week as well, from McDonald's and Restaurant Brands International and Chipotle, is you have a lower income consumer that has been struggling for about 2 years, and that has impacted some of these quick service names. That has broadened out over the last maybe 9 months into the middle income consumer. And look, Wendy's is in fast food, but they also are kind of broadly accessible by a lot of America. And that broadening out, I think, has continued to kind of cause issues for this space. Wendy's specifically, if you listen to the conference call, a lot of the challenges are that they focused on throwing too much at the consumer. They over-marketed, and maybe with a little bit less focus on operations and a little bit more focus on marketing. That ended up not being necessarily the right strategy so far this year, and they're trying to repivot back towards fewer, more impactful product launches.
Yeah, I guess they had some Frosty stuff. They had a tie-in with Takis, a lot of different things, as you point out. What has been the role also of beef prices, which we know have been rising?
That is a challenge for this space. A lot of the companies that have more exposure to hamburger beef, the big hamburger players, are kind of calling out mid to high teens beef inflation so far this year. And that's starting to put upward pressure on commodity costs. It's why you've seen McDonald's, when they launched snack wraps, a lot of it was around chicken. You've seen Taco Bell highlight chicken so far this year. A lot of that's to try to avoid the beef pressure that's weighing on the business.
So Greg, let's get to Texas Roadhouse. I know you have a buy rating, and obviously you're a fan. You got the hat on. So you're repping Texas Roadhouse this morning. We should mention for viewers as well, you do have a neutral rating on Wendy's, and we talked through some of the challenges and why you're not as positive on that name. So Texas Roadhouse looked like it had a pretty solid quarter, but again, the shares are going in the opposite direction of what you might expect. What's going on there?
Yeah, earnings season for restaurants have been really challenging for investors to navigate. I would say for Texas Roadhouse, the same-store sales beat. The top line results of the business are clearly doing well. They raised their commodity inflation by about a point. I think investors and us were maybe expecting that to go up about half a point. But just to point out, labor is going the other way. You had labor inflation for the year get revised down slightly in the guidance. They talked about the start to July maybe being 50 bips slower, a little bit slower than where they were in the quarter. But I think there was some pressure with July 4th shifts that we think you're going to see maybe accelerating sales in the second half this year, and maybe a point better than consensus. We really like the stock. We think it's for a business that's growing mid-single digit unit growth, low single digit traffic, trading in a little bit over 21, 22 times. It's very reasonable. And we think shares make sense to be buyers.
And just quickly, they've rolled out another concept called Bubba's 33. What's that all about?
Yeah, so Texas Roadhouse, the strength of Texas Roadhouse is in how they manage their stores and their labor incentive program. They allow their managers to have a lot of autonomy over the operations and the decision making in the stores, more so than any other chain. They are now taking that model that they have put on in the steak category and bringing it more into a bar and grill category with a concept called Bubba's 33. The results there have been very good the last 12 months. The new stores are performing extremely well, and the returns are getting close to where they are at Texas Roadhouse, which are phenomenal. And so they are starting to accelerate that more aggressively into next year. There's not that many of them around the country, but there will be more going forward.
Greg, thanks a lot. He likes the stock so much, he's wearing the hat. I think that's the first time here, Greg, on Yahoo Finance. I like it. I like it. It's Friday. Have a great weekend.
You know.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, Firefly Aerospace pulling back after soaring in its NASDAQ debut. We've got an investor playbook for how to trade stocks fresh off their IPOs. Plus, a deep dive into sector ETFs, why they could have a concentration problem. And SoundHound AI tripling its revenue year over year. We'll talk to the CEO about how voice AI tools are being used in everything from healthcare to restaurants. All that and more coming up on Market Catalysts. 90 minutes into the start of trading, I'm Julie Hyman. Let's get a check of the markets here. We have been seeing the major averages rally throughout the session, and that is continuing. There has been some reporting out there that the U.S. and Russia are in talks to get to some sort of deal on Ukraine. Maybe they're making some progress there, as some of the reporting has indicated. But we do have communication services and financials leading the gains that we're seeing in the S&P 500 today. The strength in tech is also reflected in what we're seeing from the NASDAQ, which is up 0.2%. IPO activity has picked up in 2025 after 3 years of sluggishness. 127 offerings have been priced so far this year. That's up 53% from 2024, according to Renaissance Capital. While most companies that listed this year have had massive debuts, their share prices have since fallen from those initial heights. So how should investors trade those IPOs? Joining me now, Avery Marquez, Director of Investment Strategies at Renaissance Capital. Avery, thanks for being here. We appreciate it.
Yeah, absolutely.
So as we know, pricing of an IPO is more art than science. The bankers want to price the stock low enough that maybe it has some further upside, but not leave too much on the table for folks who are trying to exit the stock. When you see these stocks pop and then come down, what does that tell you about maybe how the IPOs were priced?
In this case, I think that there is a very important factor at play, and that is just pent-up demand for these new issues, these big name new issues. As you mentioned, the IPO market has been very slow the last few years. So public investors have really been starved of these high-profile IPOs. And now that they're coming back, we do see this, as you mentioned, very high pricing and very strong demand on day one. But that doesn't necessarily mean that it was maybe priced incorrectly. But that's where investors are indicating their demand. So in this case, I think it really is, just that pent-up demand and maybe a little bit of hype and FOMO returning to the IPO market.
Yeah, definitely. We've seen signs of that elsewhere, of course, as well. Are there particular types of IPOs that have proven especially popular?
Tech is the big one. We saw that with Figma. We've seen that with eToro and Mountain, definitely with Circle, if you, I guess, count that more as tech, fintech. Tech has been a big area. And again, that's because we haven't seen these really high profile tech unicorns for the past few years. So there is just demand for those names now that they're coming back to market. Coming back to market with perhaps stronger fundamentals than they would have had if they had come to market back when things were very frothy in 2020 and 2021. But we're also seeing increased demand in areas like space and defense. We've seen that with Firefly and earlier this year with Karman and Voyager. And I think that we can attribute that to kind of just sector tailwinds. We have a pretty, space and defense forward administration right now. So those are two areas that I think this year have proven that investors are eager to get in on.
So when investors are trying to figure out whether they should buy a recent IPO, what kind of criteria do you advise they look at? And are there certain things they need to consider for recent IPOs that are more relevant than they would be for companies that have been out for a while?
Absolutely. Some criteria I think are kind of basic, just strong fundamentals, compelling growth. But I think it's important for especially retail investors to remember that while missing out on a big pop can hurt, the IPO is really more than just the first day. These companies are considered new stocks, unseasoned equities for a while, 3 years by the Renaissance IPO index's standards. So there is plenty of time after that really, very early trading period to get in on that transformative time in these companies' public lives.
When you look at the Renaissance IPO ETF, it's up, around 12-13% this year. The S&P 500 is up about 8.5%, so we've seen that outperformance. Do you think that's going to continue, and what's going to continue to drive that outperformance, if so?
Right now, I think it's hard to predict that. We have done very well, especially in the last 3 months or so, since that really strong rally in the post-tariff April period. What could continue to drive outperformance in the IPO ETF compared to the broader market indices is just going to be continued demand in the aftermarket. We see these big pops. I think those pops get investors interested. Now what's going to matter is seeing continued demand, continued interest in the aftermarket.
And in terms of what maybe we're looking for next, Klarna is probably the biggest one that we talked about. It was coming, then it delayed, then it was coming again, then it delayed. So do you expect that one this year, and what do you think the demand is going to be there?
As of right now, yes. I've seen reports that it's expected or reportedly planning to launch in September. So that's like really the only big name in the visible public pipeline right now. Other than that, most of the fall activity, the early 2026 activity is going to come from that private backlog. So the companies that haven't filed publicly, maybe they've confidentially filed, but are just indicating steps towards IPO. We've seen a lot of activity in the digital asset sector with Grayscale Investments, with Gemini, Figure Technology. Beyond that, some broader tech. I know that Avalara is looking to re-IPO. But yeah, the majority of fall and early 2026 activity is going to come from that private backlog.
Avery Marquez, thanks so much. Appreciate it.
Thank you.
We got much more market action coming up, including your latest edition of Stocks in Translation with our own Jared Blickery. You're watching Market Catalysts.
The S&P 500 has a concentration problem. The most important stock index in the world is more top-heavy than it has been in the last 45 years. The 10 biggest stocks, they make up nearly 40% of the index. And in today's Stocks in Translation, we are going to take a look at the problems that ETFs have had recently trying to track the S&P 500 sectors. And we're going to take a look at some of the brand new ETFs that are trying to get around this concentration issue. And most of this work, by the way, is work of Todd Sohn. He's over at Strategas ETF Research. Now, let's start with the definition. What's behind this mess? The rules for registered investment companies, or RICs, were created way back in the 1930s and 1940s for mutual funds to make sure they didn't get too concentrated in just a few stocks. But modern ETFs that only go back to the beginning of the century, they have to comply with them too. In particular, these so-called RIC rules, they say that no single stock can make up over a quarter or 25% of a fund. And the sum of all the stocks together making up at least 5%, they cannot exceed half of the fund or 50%. So it's great for diversification, but in a mega cap world, it forces ETFs that are supposed to be passive to dial down the biggest names. Now look at this table of 4 S&P 500 sectors and their top 3 stocks. For instance, in communication services, we have Alphabet or Google with 38%, Meta with 31%, Netflix with 10%, Add them up and you get 79%. That is way too far over that 50% that's required by the rule. And a similar thing happens with the tech sector, with consumer discretionary, and this one surprised me, even the energy sector. ExxonMobil, Chevron, and ConocoPhillips, they add up to 55%, just a little bit too high. But the bottom line is, an ETF cannot just copy and paste that concentration and still pass the Rick test. They have to cut their biggest weights. Now here is the real world impact. In this chart right here, the performance of the S&P 500 tech sector in green, this is since the start of this bull market in October of 2022. That white line below it, that is a performance of the Technology Select Spider Fund, which we know by the ticker XLK. All you need to notice is that big gap between the two lines at the right side of the chart. XLK is up 126%, but the actual tech sector of the S&P 500, that's up 158%. And that is a difference of 32 percentage points. That's a big gap. Here is the same story in a table that shows the gap in performance for all four of the sectors we've been discussing over this nearly 3-year-old bull market. Tech has the biggest difference. We just took care of that. But communication services with Alphabet and Meta, that has a difference of 16 percentage points. Then you can see there's only a small difference of 3 percentage points for consumer discretionary. That's where you find Amazon and Tesla. And there's virtually no difference for the small returns in the energy sector, which is more or less traded sideways through this bull market. So here comes the fix. There are newer ETFs designed to get closer to the index concentration while remaining compliant with all the rules. This table here, it focuses exclusively on the tech sector and its 3 biggest weights. Those would be NVIDIA, Microsoft, and Apple. We have the weights of each within the S&P 500, the weights within the new Global X Pure Cap Tech ETF with the ticker GXPT, and finally at the bottom we show the weights in XLK, which we've discussed has been around most of this century. Note that the new GXPT ETF gets much closer to the weights in the S&P 500 for those 3 stocks. Now finally, this table here shows the total weight of those 3 stocks, NVIDIA, Microsoft, and Apple, in each of the same 3 instruments from the last table: S&P 500 Tech Sector, GXPT, and XLK. Now the new GXPT at 60%, it gets pretty close to the S&P 500 Tech Sector at 62%, while XLK is stuck down at 42%. Now, there is a trade-off to getting around all these concentration rules, and it comes down to fees. GXPT charges a management fee of 0.25% per year, while XLK, it's only 0.03%. That's 1/8 of the new tech ETF. So you're paying more to get closer to that concentrated index profile. I should also add that the select spider funds like XLK and XLY, they aren't doing anything wrong. They're just following the rules that they've been in place for decades. So the bottom line is, in today's market, it's built around a handful of colossal winners. In concentration, it may ease or it may stick around, but at least now you can choose how closely you want to ride with the giants. Tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. More market catalysts after this.
Time for some of today's trending tickers. We are watching oil prices as well as Goodyear and Sweetgreen. First up, oil traders weighing whether U.S. efforts to try to end the war in Ukraine could impact overall supply. Washington and Moscow reportedly nearing a truce that would see Russia hold on to territory seized during the war. That's according to Bloomberg. And the jitters are compounded by President Trump's tariffs on India due to its purchase of Russian crude oil. Prices heading for their longest losing run since 2021. Next up, Goodyear reporting disappointing second quarter earnings. The tire and rubber company said it expects market challenges to continue, with the recovery in the commercial truck market not anticipated until next year. The stock is falling as much as 24% today. Right now it's down 18%. It's seeing its worst losses in over 3 years. It did recover from intraday lows, but still down double digits. And finally, a sour trading session for Sweetgreen. The casual salad chain missing Wall Street's second quarter revenue expectations with sales flat year on year. The company also cut its sales guidance for the full year, and that happened for the second quarter in a row. It cited tariffs, weaker consumer sentiment, and the underperformance of a majority of its locations. Those shares are down by 28%. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Yahoo Finance executive editor Brian Sozzi got a chance to speak with Jonathan Ross, the founder and CEO of Groq. It's an AI company partnering with OpenAI.
Lots of focus this week on everything that OpenAI released, a new model for them. Took about 2 years to develop. Now, you work closely with OpenAI. What's your take on that model, and how is Groq leveraging it?
Well, thank you. Yeah, so OpenAI just released an open source model this week, and then they surprised everyone by also releasing a brand new frontier model. So we were a launch partner for their open source model, and one of the things that they were very excited about is the speed at which we could run that model, much faster than is possible on a GPU.
I think some of the early thinking off of this model, Jonathan, is that there was a letdown component. Perhaps we're slowing down in terms of development, how fast these models could push things. What was your assessment of it?
Well, so the vibe checks when you actually use it have been pretty good. One of the things that often happens is benchmarks fall behind, and it makes it really difficult to keep up. Think of it as a really prodigious student. When they're taking a test, sometimes they will do better than the test can show. I think it'll take a little bit of time for the industry to understand exactly where the model's settling out, but most of the people that I know who are really deep into this are pretty excited about the model.
I imagine one of the biggest takeaways from this model, Jonathan, is that the hallucinations or the mistakes are starting to get fewer and fewer.
Yeah, and one of the things, I often don't like to call it hallucinations. I like to call it a mistake, right? Because models make mistakes. And one of the questions that we often get asked is, how can you use these models if they make mistakes? Well, human beings make mistakes. The question is, are you making too many mistakes to be useful? So one of the things with this model is by making fewer mistakes, it's now going to be useful in more applications. So it may not be yet ready for healthcare, and making diagnoses, but it's getting closer and closer to that point. And each time a new model is released that makes fewer and fewer mistakes, you're going to be able to use it for more and more critical tasks.
And of course, Jonathan, we see these models continue, that development continues to move at a rapid pace. What does that mean for your business?
So for us, more open source models give us more options. So right now, Groq is actually the most popular API for running models that are open source or open weights. I believe about 33% or so of developers who develop AI applications now use us, which makes us, I think, one of the most popular. And we mostly use open source models. So just like everyone else, we run the same models. The difference is when you get access to these models, the differentiation becomes the speed at which you can run them, the cost at which you can run them. And what we offer is price performance. Now, one of the things that we're really excited about is this new US AI stack that's being developed. We've actually deployed our chips around the world. We refer to it both as the home game and the away game. The home game is making sure that you actually have enough compute at home to satisfy your needs. The away game is making sure that people around the world are actually using US compute. So we've deployed in Saudi Arabia, we've deployed in Europe, and we're going to be deploying in a lot of other places around the world. And we're really excited because our chips are currently made in the United States. And what we would like to do is also have these US leading edge models deployed on that hardware.
Jonathan, how difficult is it to make chips in the United States? We're all watching the high drama unfolding at Intel, but again, this is a country that you and I both live in, still very reliant on chips coming from a Taiwan semiconductor.
It's incredibly difficult to build chips in the United States. We're just now building the ecosystem. Even when chips are manufactured in the United States, it's really hard to package them in North America. And one of the reasons is all the other AI chips use a component called HBM, or high bandwidth memory. And that tends to get packaged in TSMC. So even if you are fabbing your chip in the US, it still gets sent to Taiwan in order to get packaged, and then it gets sent out. In our case, we're unique in that we're able to do this fully in the United States or in North America.
What's the risk to the development of AI models and the AI thesis more broadly, Jonathan, as a result of any of these semiconductor tariffs that may get put into place?
Well, I think if you read the most recent tweet very carefully, it's really intended to entice people to get on a trajectory to build in the US, and we strongly welcome this. So while we've been doing this since we were founded in 2016, it's been very difficult, and we did it before it was popular. these incentives or pushes to actually manufacture in the US are just going to make it easier for us to continue doing what we've been doing. And if you read the tweet carefully, if you have a plan or if you are working towards building in the US, you will be able to avoid those tariffs. And we're all in favor of that.
Jonathan, so many executives in the industry, the chip industry, have told me that we need Intel. We need Intel. The U.S. has to have Intel. But I just see what's going on over there. I've talked to you before. I see the work that you're working on. I see what NVIDIA is doing, AMD. I mean, does the U.S. really need a strong Intel when we have companies like yours and NVIDIA and AMD continuing to do quite well and push the groundwork forward for all things AI?
So if I was coming from a selfish point of view, I would say, no, we don't need them. The reality is they're producing chips that sometimes compete with us. But from a U.S. standpoint, the more semiconductor companies that we have that are able to push the bleeding edge in the technology, the better off the U.S. is, and I'd rather focus on that. I do think it's important that Intel be in a strong position. It is one of the strongest foundries. We work with global foundries currently. But if Intel were stronger, that would be good for the US. I think the question for everyone is, how do we get Intel in a place where it's strong again? You don't get to do it just by handing money out. You have to fix some of the systemic issues. And in my experience, Intel has an amazing long culture. They blazed a lot of the culture in Silicon Valley.
But bureaucratic, Jonathan. I think that's been one of the problems in hindering their growth.
Well, and I think this has been identified, so I'm not going to be breaking news to anyone at Intel, but for the rest of the world, Intel got to a point where it became a little bit smug and thought that everything it was doing was great, even when it wasn't. Intel now understands that reality, and that was the first step in them moving forward. I do think Intel has a chance to turn it around, and the question is, will they?
Jonathan, since the last time I talked to you, a report earlier in July from The Information saying that you might, or you would like to raise between $300 and $500 million to help fuel your growth. That would value the company at about $6 billion. Anything you can share on that front?
Well, Brian, one of the best things about being a private company is
I knew that was coming, Jonathan. I know where you're going, man.
Yeah.
I mean, but do you need that capital? Like, is the demand so strong right now that it's time to pull the trigger?
So at this point, we are supply limited, not demand limited. So we've launched a couple of models that are quite popular, and individual customers are interested in that capacity. We had planned to deploy 70,000 chips in one particular deployment, and it now looks like one single customer is going to be using that. And we didn't expect that level of demand. One of the things that is unique in this market, and I want to differentiate generative AI from SaaS because they're totally different. So in SaaS, you write an application, and that is the quality of the application based on what you wrote. In generative AI, what you can do is you can turn up a knob, you can actually produce more tokens and increase the quality of the output. And so you actually can spend money to make your product better, but only if you have the capacity to turn that money into tokens. And so that's one of the drivers that you're seeing. We've never had a situation before where you could literally just turn a knob and make your application better. You had to have developers do it.
Lastly, Jonathan, you're working very closely with folks in Saudi Arabia to help scale up their AI infrastructure. How large an opportunity is Saudi Arabia, just not for your company, but for the wider tech industry?
Massive. So Saudi Arabia has been going big on this. So we've been working with Humane. And so Humane is going quite large. They've been an amazing partner to us. So the 19,000 chips that we deployed in Saudi Arabia last year, 51 days from signing, we had it up and operational. And that was largely thanks to the speed at which they were able to move and remove hurdles. We can't even build that fast in other places in the world that are used to moving quickly. It's amazing.
All right, we're going to leave it there. Always great to chat with you. Learn a ton as always. Groq founder and CEO Jonathan Ross. Have a good weekend. We'll talk to you soon.
The Trump administration is planning to take Fannie Mae and Freddie Mac public later this year, according to the Wall Street Journal. The plans reportedly being discussed would involve selling between 5 and 15% of their stock, valuing the companies at roughly $500 billion. It's unclear whether the mortgage giants would IPO as one company or two separate entities. Of course, the two have been under government control since the 2008 financial crisis. It's unclear if they will remain under government conservatorship. That is something that has been sort of left vague. And what's new in this report here is the $30 billion that could be raised and the potential timeline here that the Journal is reporting on, that it could potentially happen later this year. Now, folks that we have spoken with who have watched this situation closely and who have tracked the government-sponsored enterprises for years have said that this is a highly complicated potential transaction here. So they might question the idea that this could happen this year on that short of a timeline. I have heard more years-long timelines with regards to bringing Fanny and Freddy public here. So we'll have to see how this indeed does all play out. But we are seeing the shares reacting of those two entities, Fannie and Freddy, both up 3% for Freddie Mac, about 4.5% for Fannie Mae. We'll continue to track it and bring you any further developments as we get them. SoundHound AI is surging after raising its full-year revenue outlook. The company reporting a record second quarter as more companies adopt its voice AI tools. Joining me now is Keyvan Mohajer, who is SoundHound AI co-founder and CEO. It's good to see you. Thanks for coming in studio.
Thanks for having me.
So you guys saw revenue that more than tripled in the quarter, and you have three main business lines. You've got autos, you've got enterprise, you've got restaurants. Where was that demand coming from?
It actually came from all of those. So it was a blowout quarter, strongest quarter on record. Every business unit delivered success. We had growth in AI for automotive, AI for restaurants, and AI for enterprises. We closed new deals. We had cross-sells across these units, which was amazing. We also made a lot of progress with our voice commerce, which is something we demonstrated earlier this year.
How does the voice commerce work?
So it's a great example of agentic AI. So everybody talks about agentic AI as a vision of the future, but SoundHound is actually bringing that to life at scale because of our reach and technology. So imagine you're driving home from work. Historically, you've had limited use cases of your AI in the car, maybe navigation or setting the fan speed. What if you could do more? What if you could find a restaurant that your family likes and placing an order for dinner by talking to the car? Maybe you book some appointments for the next few days, maybe healthcare appointments or salons, or the groceries. And SoundHound is doing that. We are working with prominent auto OEMs, automakers in Europe, in North America. We have participation from restaurants and merchants with national and global coverage. That's going really well, and everyone is rushing to be a part of it.
So can I buy a car now that has this product, or this is something that is in development that would come to a car when?
So you could buy a car that is powered by SoundHound. So we are in millions of cars. That's pillar one of our business. And we are now running pilots with several OEMs, car OEMs, some that are using us now, some that are not using us, but they are going to use us. So it's in the near future.
One of the reasons I like talking to you, Keyvan, is I think that the whole idea of Gen AI, agentic AI, is very conceptual in some cases. And I like talking to you because it sort of makes it more real in a way. So I want to ask you about another example. You have a lot of restaurant deals, as we've talked about before. A couple newer ones, I think you signed IHOP, for example, Red Lobster, for example. If I'm a customer, how do I interact with your AI at these establishments?
Yeah, so we are omni-channel. So in some cases, the more prominent channel for those restaurants is phone. So you call them and you can place an order. A lot of times when you call the restaurant, they don't pick up the phone, or if they do, somebody's very distracted and busy in a noisy environment. So all of that is going to go away. You always get somebody, AI, to pick up the phone with patience, and you can talk to them at any speed that you want, and you can place an order. Sometimes their channel is drive-through. So we power the drive-through with AI. And we can, our solution increases the revenue and decreases costs. So restaurants now need us more than ever because we help them in both top line and bottom line. Reduce cost, that's obvious, but we upsell. AI always upsells, and the throughput goes up. We can take orders faster. We can take orders parallel, multiple lanes, and so on. So that increases the revenue.
Can the people keep up with the increased orders?
You know, we actually have had cases where they had to turn it off.
Wow.
Because they couldn't keep up.
That is really interesting. I guess that's a Unless you're expanding into, burger flipping machines, I guess that's another issue. You guys rolled out your new agentic platform called Amelia 7. So how is this being deployed and kind of what makes it different?
So it's the agentic version of, we even call it Agentic Plus, agentic version for AI for enterprises. Another example of agentic that I can explain, so in customer service, traditionally, when you called and got AI, the AI handled very simple cases, maybe answer question or just figured out what you want. And then for more complicated things, you got escalated to human. Now, AI can do more complex things. So for example, if you, for troubleshooting, agentic is perfect, or for healthcare appointments, let's say you want to book an appointment for yourself and for your child, maybe not at the same time, but on the same day,
right.
different doctors, and that's a very complicated criteria, and that used to, be escalated to humans, but now agentic can handle that.
Interesting. Yes, I've definitely had that experience. Do you guys use your own LLM for all of this, or is it powered by a different one?
So that's one of the great things about SoundHound is that we have our own foundation models, but we also utilize third-party models, and we are very fast to adopt when innovation happens outside of four walls. And like when 2 years ago OpenAI opened their API, we saw it as opportunity because we thought Google, Amazon, Apple, they're not going to sign up for an OpenAI right away, but we can, and that made our products better. But SoundHound also has its own model called Polaris. And for what it does, it beats our competitors by a large margin. So for example, we beat the closest competitor by 35% in accuracy, by 4 times in latency, all of that at a lower cost.
Interesting. Okay, finally, I want to ask you about profitability, okay? Because obviously you guys are in growth mode. I believe that analysts are looking for positive EBITDA next quarter, but kind of what does that journey look like? When are you going to sort of turn your focus to from growth to that profitability question?
Yeah, it's a constant conversation because the opportunities are limitless in front of us, and I think we are at an inflection point for enterprise adoption of AI. It used to be, POC budgets or innovation budgets, but now it's a mandate from their IT budget, and they need a partner like SoundHound. So investing in growth is very important for us, but we also want to be as close to profitability so that we can decide when we want to get there. At the moment, we are guiding that we will exit the year on an adjusted EBITDA positive basis.
Right. And then you guys have been very acquisitive in order to grow in part as well. Are you kind of slowing that down, or are you still full steam ahead with making more acquisitions?
We bought 3 companies last year, and those have gone amazing. We think we have demonstrated a repeatable formula for success. So first, we bought companies that were amazing on their own. They had great solutions, great teams, amazing customer base. And then we gave them what they needed to thrive. We replaced their legacy tech dependencies with SoundHound's own models that improved the quality of the user experience while lowering their expenses. We explored a lot of cost synergies. We did cloud migration, revenue synergies, upsells, cross-sells, which showed up in our financials. I mean, our financials speak for themselves. And all of that happened in 12 to 18 months. So we think we've become good at it, and we would be able to do it again, but it does depend on finding the right targets that are great on their own.
Where do you think you would want to add to?
So our future doesn't depend on it. So we have the scale that we need now, but it's all about accelerating our market share and going into new verticals. So we went to, with the last acquisition that we had, now we are in the top 7 of the top 10 financial institutions. We are in healthcare, we are in insurance, we are in military, and more of that would be welcomed by us.
Okay, Kayvon, thank you so much for coming in.
Thank
it's good to see you. Appreciate it. Coming up, how one Robotics CEO is planning for growth as big names plan to enter that space. We'll be right back. More than 2 hours into the trading day, let's take a look at what's going on in markets here. We have all 3 major averages higher. The S&P 500 gaining about 0.5%. And you can see earlier in the session, we had some headlines about potential progress that the U.S. and Russia were making in their talks to potentially have a ceasefire with Ukraine. So that's seeming to give a little bit of a leg up to things. The NASDAQ up 0.2%. The Dow's up about 0.5%. It has sort of taken a little bit of a leg lower. Wanted to look at the weekly numbers numbers as well. The Dow's up about 1% on the week, and we've seen it sort of diverge from the other averages. The S&P is up twice that, and the NASDAQ is up 3.5% on the week. So the Dow has really been the laggard on a weekly basis here. We also continue on those Russia headlines, by the way, to continue to keep an eye on what's going on in the oil market. You see the 5-day move lower in oil prices, and then once again today seeing a little bit of a leg lower. That was when we got those headlines about Russia. So we're going to keep monitoring that. And gold has been really interesting. That's after the Financial Times reported late yesterday, and then Bloomberg also confirming that some gold bars being imported into the U.S. were going to be tariffed. The gold industry did not expect that at all, and it has thrown a lot of the basis for gold futures into question here. You see on the day an increase in gold prices. We've seen gold miners trading higher as well. And then digging into equities a little bit, looking at the NASDAQ, which is the outperformer on the day and on the week. You have some of the large cap tech names really gaining today. Apple up 2.3%, Nvidia up better than 1%, Alphabet up about 2.7%. So some interesting moves there. And then on a sector basis, you've got the XLK, which is the tech ETF, rising the most today, but financials close behind it. So those two groups accounting for a lot of the gains today. We've got interest rates coming up a little bit in today's session, Treasury yields rising a bit, and that's putting pressure on utilities and real estate. Moving on to one particular company, it's Serve Robotics. Sales jumping 46% in the latest quarter. The company hoping to keep the growth going, planning to double its number of available robots in the third quarter. The company also building on its partnerships, now delivering Little Caesars to Los Angeles area Uber Eats customers. Joining me now, Serve Robotics co-founder and CEO Ali Kashani is back with me. Ali, it's good to see you here. So when you look at the quarter, what in your view was driving most of the growth in the demand?
Well, we increased our delivery volume by 80% quarter over quarter, which exceeded our own expectations. And a lot of that came from expansions. We launched Atlanta. We massively increased our geo coverage in LA and Miami. We now cover 1.8 million people. So, it's a pretty sizable coverage now, and it's starting to show.
And so what's next here? Are you guys just really focused on signing more contracts with an expanded range of food businesses that people want delivered?
Yes, we are expanding the fleet, we are expanding our geolocations, and we are expanding the partnerships. We're going to quadruple our fleet size again by the end of the year, and we've already quadrupled it once this year. So we're going to get to about 2,000 robots that we had guided to, and we are also launching Chicago. We probably have one more announcement in terms of city launches before the end of the year. So it's been an exciting year. It's going to keep going in the same direction with a lot of growth.
I'm curious, Ali, sort of what the capacity is here, and I ask that because I've seen your robots sort of tootling around in LA, for example. For people who are not familiar, it's sort of a boxy robot on wheels. Obviously, LA's a big place. New York's a big place. But the sidewalks are only so big, and you have to account for traffic, et cetera. So, I guess what it ultimately is the size of the opportunity here that you're looking at.
Look, I think this is a massively market expanding opportunity, and over time, I could imagine that cities would actually have dedicated infrastructure for it, but it's going to be a long time before we saturate what's already out there. I did the math once a few years ago, and if we did 50% of deliveries for, at the time, Postmates platform, and 50% is roughly what's within our delivery range, you would see a robot every other block. So it's not, it's like a UPS truck, basically. That's one way to think about it. But the fact is that if we bring the cost of delivery from something like $10 today to $1, where we think we can get it to, you're going to have a lot more people wanting to use robots for a lot more things. And I think there's a point at which I can imagine even dedicated lanes and infrastructure for last mile kind of automated devices like our robots.
Ali, we have seen the stock under pressure here, and you guys did post losses. You're just like our last guest we were speaking to. You guys are in growth mode here, but what's the cost structure look like in terms of when you might hit that inflection point of growth and profitability?
I think the launch of the 2,000 robots is a really big milestone for that because we get a lot of economies of scale from that. Ultimately, last mile is a low, revenue per transaction, so you need a lot of scale to make the numbers work, and that's why we are launching the 2,000 robots.
I would think that in terms of competition here, obviously you have the traditional modes of competition, bicycle delivery, car delivery, et cetera. But in the future, I would also think that the drone delivery is going to be more of a competitor to you guys. So how do you think about that and sort of how you compete against drones in terms of the use cases for each?
I actually see them very complementary because delivery has always been multimodal. You have different vehicles for different types of deliveries. So if you're in a city, drones are never going to be that suitable because there's a lot of obstacles to navigate. Drones have noise. There's safety concerns. It's not a really good mode of operation when you are in the middle of a city. But if you're going 5 miles away, our robots is not going to be the right way to do it. Together, they actually work really nicely, and we have a partnership with Wing, Alphabet's drone division, where we pick up the order from restaurants, which is very hard for drones usually to get to, and we hand it over automatically without human involvement to the drone, and the drone can then go 5 miles and hand it over to the customer even faster than, say, a driver would be able to do. So I actually think they're really, really complementary, and as one grows, the other is going to grow with it.
So Ali, you guys, I believe you're in LA, I believe you're in Miami, expanding into Atlanta. Can you give us a preview of what other markets we should be looking for in the next 6 months?
Yeah, we are going to have at least 6 markets by the end of this year. So LA, Miami, Dallas, and Atlanta have already been launched. Chicago is next, the 3rd largest city. And then there's one more. We haven't named the city yet, but we are working on at least one more before the end of this year.
Okay, looking forward to finding out what that is, Ali. Good to see you. Thanks for joining us.
Thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Have a fantastic weekend, everybody. We got more Yahoo Finance coming up.